Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
What happens if your life insurance dies before you do? Stay tuned to find out.
Welcome to the only show in the country dedicated to helping savers worry less about money, the Worry-Free Retirement, with your host, the author of 4 books on retirement and offices in Bowling Green and Louisville, Kentucky, the money missionary himself, Tony Walker.
Welcome to the Worry-Free Retirement. I'm Tony Walker. By the way, I don't know if you ever saw the old show Fury, about the horse Fury. I used to watch it as a kid, and it always amused me at the first of that show when it introduced all the cast of characters. They always introduced Pete. He was the old farmhand, and it said Pete, who cut his teeth on a branding iron. And I never understood what that meant until finally my dad said, well, that's what he first started doing. So it kind of leads me to my point today. We are going to talk about life insurance, and if you own a policy, thinking about buying life insurance, thinking about getting it for your kids or what, this is going to be good stuff, folks. And it's also going to help you understand how life insurance even works. But basically in 1984, that's what I cut my teeth on when I entered the financial services industry. I got in the field of finance by way of my late great father-in-law, who at the time, back in 1984, owned a property and casualty insurance firm there in Bowling Green, Kentucky. Now, looking back, I was age 24. I knew nothing about insurance, certainly nothing about finances, life insurance, economics, none of that stuff. I mean, I just graduated earlier from Western Kentucky University there in Bowling Green, where I had a double major in broadcast communications and psychology. Now, think about it before you laugh a minute. Actually, the broadcast communications has been come in handy since I've done TV now for over 20 years. And the psychology in our field has helped immensely. In fact, psychology is used by many people today. We use it with the 3 personalities of money. So I'm actually glad I had that background. And of course, I've got numerous economic degrees and studied under some great people since then. But anyway, so how in the world, Tony, did you get in finance? To which I would reply, other than the fact that the old job of broadcasting didn't work out. Let me give you a scenario. I graduate from Western. I'm all excited. You put these tapes together. You know, I've got all my little TV stand-up deals. Aaron's laughing. He was in this business. He knows about this. You know, I've got an old tape. It's a 3/4 U-matic, for anybody who knows what those are. I got to figure out, find a machine. I want to see that thing. I've got it, Aaron, when I was in college. I bet that thing is hilarious. So I'm sending it all over the country, all excited. I only get one offer. It was a nighttime gig at some station in Grand Junction, Colorado. My wife says, hey, fine, if you want to take that job, Tony, I think I'll stay in Bowling Green. So needless to say, I didn't pursue any dreams in broadcasting. That was the end of that dream. So I stayed back in Bowling Green, which I'm glad I did. And the rest is history. Started with my father-in-law, did not really personally enjoy the property casualty insurance business. At the time, my father-in-law had a very good understanding of life insurance. He was what was called a CLU as well, Chartered Life Underwriter. So he said, Tony, you ought to try this out. Well, I got into it and I loved it. I love talking to people about life insurance, goals, death, unfortunately death. All that stuff was up my alley and I didn't mind talking about it. So I got my CLU, Chartered Life Underwriter designation, when I was only 28, one of the youngest in the country to have that at that time, and off we go. So here I am with my life insurance licensing. Interest rates are way up in the 12 to 15% range in the 80s. Folks, Aaron wasn't even born then. Yeah, do you remember that? Interest rates were 12, 13, 14%. All you had to do is run your money down to the bank and you got 12% on it. You know, nowadays you get 1 or 2% or whatever. And again, insurance companies, you have to understand, insurance companies, they weren't paying high interest rates. Life insurance back then, the main policy back then was something called whole life, which was backed by long-term bonds. So when interest rates spiked in the 80s, hang on folks, I'm going somewhere with this. You need to understand how this works. When interest rates spiked in the 80s, these old whole life policies couldn't keep up because the insurance companies had all these long-term bonds. So what did the insurance companies do? They're not stupid, they're losing money, right? So they go out and they create a brand new policy called universal life or adjustable life, and all of it was based on short-term interest rates, which I remember at the time, I was training under a gentleman by the name of Ron Russell. He was with Aetna Life back then. He said, Tony, when you're showing these universal life illustrations as projections, just use about 10% because then that was considered a very conservative interest rate. Aaron, isn't this funny? You're listening to this probably thinking, I don't know, did that time even exist? Yes, it existed. So in other words, if you purchased a universal life or adjustable life, we'll go over those 4 types in a second, this is what was going on, all right? You were assuming that interest rates were always going to be 12 or 13%. So let's do something a minute. Let's kind of take a look at the 4 types of life insurance because you need to understand this as we go into our next segment. Basically, when you boil it all down, there's 4 categories of life insurance. You have term life insurance, you have whole life insurance, I like to call it dividend participating whole life. The 3rd type is either called adjustable or a universal. Now this was the type, and it's still around, and it has its applications, but this was the type that was sold like crazy in the 80s and 90s. When we come back in our next segment, I'm going to go over an exact example of one of these policies in 1991 that somebody came in with the other day and wanted me to look at it. Bottom line, the thing's about to fall apart because interest rates are much lower than they assumed. Oh, by the way, here's a good one. The latest craze is index universal life. We got the same problem we saw in the 80s and 90s. All of these agents are assuming that these indexes are going to make 6, 7, 8%. Folks, if you're looking at a policy somebody showed you recently and it's index universal life, and they're assuming 5, 6, 7%, and they're showing you all this income in retirement, you better be really, really careful. In fact, what I would ask you to do, have them rerun the illustration at 0%, because that may be all it makes, or the guaranteed minimums, and that's it. And then finally, the 4th type or category of life insurance is what we call variable life. Okay, you got it? So basically, we're going to go over these 4 categories when we get back. We're going to talk about life insurance. So again, whether you own a policy, looking at buying a life insurance policy, thinking about it for kids or grandkids, you want to stay tuned because this is going to be really, really good stuff. I'm going to get out the whiteboard. I'm Tony Walker. You're watching the WorryFree Retirement. I'll be right back.
Are you worried about going broke in retirement and being a burden to your children? Plan on attending Tony Walker's next free workshop, Retirement 101, Tuesday, August 15th in Bowling Green and Monday, August 21st in Louisville. During Tony's workshop, you'll learn how to lower taxes and fees on your money and how to secure mailbox money for life. That's Retirement 101 with Tony Walker, Tuesday, August 15th in Bowling Green and Monday, August 21st in Louisville. Seating is limited, so register today at TonyWalkerFinancial.com.
I want to retire. The problem is I don't have a game plan. And who do you trust? I guess I'll just have to go it alone.
Whether you're divorced, widowed, or single all your life, don't go it alone. Attend my next free financial forum exclusively for single females. There's 2 times to choose from and seating is very limited. Bring a guest and log on now to TonyWalkerFinancial.com and I'll see you then. Welcome back to the Worry-Free Retirement. Incidentally, in the break there, I was just looking over a recent article on RMDs, required minimum distributions, which deal with qualified plans at age 70 and a half. And let me tell you, it has nothing to do with life insurance, but in a minute, you're going to find out, or next week rather, when I cover required minimum distributions, why life insurance plays a big part in that. And why, even if you're already 70 and a half or not quite 70 and a half, you need to understand these required minimum distributions. Again, next week we'll get into that. Right now we're talking about life insurance though. A lot of people might say, well, Tony, I don't know, what's the big deal about life insurance? I don't know if I need life insurance. I don't know if my wife needs it or my spouse needs it or my kids need it. Well, I'll tell you what, in my 33 years of doing this and delivering a lot of life insurance checks after the death of a loved one, I've never had anybody yet turn down one of those tax-free checks. I often say when it comes to life insurance, it's the only asset that you can take literally to the bank. That's because life insurance is immediately tax-free at death, and it's guaranteed at death to pay more than you put in, assuming you have the right type. So for instance, when you die, let's take a 401k. What do you get? You'd say, well, I get all of it, don't I? No. When the 401k passes on, there's huge tax implications. While you're waiting for the funds to settle, the market could crash on you. The thing could go down. It has a tax tumor. What about real estate, Tony? Isn't that all tax-free? Well, depending on how it's owned, yeah, you'll get a step up in basis on the real estate at death, no taxes, so to speak, in most cases, but then you go to sell it. It's not like you have a ready market for real estate like you do life insurance. You may take a hit on that. You may take commissions. You may have capital gains in some cases, whatever the case may be. So again, life insurance is the only thing guaranteed at death to provide tax-free, cold hard cash, guaranteed, all right? Stocks, bonds, none of that stuff can promise that. All right, so I say, assuming you own the right type of life insurance, they're going to get this cold hard tax-free cash. But what's the $20,000 question today, Tony? I'm still getting confused. Where are you going with this? My point is, why in the world would anybody not want life insurance? In fact, many of my retirees, when we start talking about this, say, gosh, I wished I'd done that when I was younger, because we start looking into life insurance when you're in your 60s and 70s, and you're going to see this in a minute. It gets very, very expensive. Now, let's talk about an illustration that I saw recently and talk about in general just this concept of an illustration. So let's go back to the 80s. If you caught the first segment, I was telling everybody about the fact that I used to sell life insurance in the 80s. Now remember, interest rates 10, 11, 12%. So the insurance companies had to provide a product that could keep up with the interest rates. Up to now, mainly they used dividend participating whole life. Whole life was backed by bonds. Bonds are long-term instruments. Short-term interest rates spiked up in the 80s. These whole life policies couldn't keep up and people started cashing them in or borrowing against them. So the insurance industry said, hey, we got to come up with something that has a short-term interest rate behind it, which they came up with something called universal life or adjustable life. Remember our four types, and we're focusing just on this particular segment. I want to show this illustration. So adjustable or universal life. So if you have one of these policies and if you took this out, especially in the 80s or 90s, you better listen closely because this could be a problem. All right, so I'm going to go over some main things here. I'm looking at an illustration on this particular person that came in. Let's look at some things here. So this was purchased in 1991, all right? Interest rates back then, we don't have the interest rate old illustration, but we're going to assume the interest rates back then, the assumption on the interest would grow at 10%. I used to run these at 10% back in the 80s and 90s because interest rates were that high. The monthly premium, oh yeah, it was a $250,000 death benefit. It was is a universal life, okay? Folks, universal life is not whole life. A lot of people come in and they'll say, I want you to look at this whole life policy. Now look at it. I'll say, that's not whole life. That's universal or adjustable. Two totally different things as you're going to see here. And back then in 1991, the premium, okay, which it still is $270 per month. And actually that's not real expensive if you ask me for $250,000 of tax-free coverage. But we're going to see there's a problem, okay? So to date, so they even ran, oh, also this does have some cash value. CV is cash value. So this contract right now, again, this is an actual contract this person wanted me to look at. It's got about $23,000. Cash surrender value means if they cashed it out, they get a check for $23,520. America's favorite financial sidekick, is this making sense? Kinda? Okay. He's trying to keep time and he's doing all kinds of things behind the scene, folks. So what happened? So, oh, this is cool. At least the people, this insurance company put this down. So over this period of time, since 1991, they have paid into this policy, that's a lot of money when you think about it, all right, $83,430. Plus they still have a monthly premium of $270. And keep in mind, I wasn't in the conversation with the agent in 1991. I guarantee you they were thinking this thing would have boatloads of cash in it, probably six figures. Why? Because again, they assumed the cash value would grow at 10%. What's the cash value now? 4.5%. You say, isn't that good, 4.5%? No, because you're going to see in a minute, only a small piece of this contract gets the 4.5%. So what is the problem here? Why did this person come in to see me? Now they are 78 years of age, all right? So this is the premium that's been illustrated. Let's over here, Aaron, right, age 78. And this was what was alarming to them. So basically, they got a notice from the insurance company, and they said, Mr. Jones, you're getting ready to turn 79 next year. If you want to keep this policy in force for the rest of your life, we need more premium. And I'll explain why they need more premium in a minute. Fine, how much premium are you going to need? let's see, I did this monthly here, and I'm going to ballpark it because I forgot to do it. Now we need a premium from you, Mr. Jones, if you want to keep this in force, of $1,160 per month. Aaron, that's a big jump, isn't it? Can you imagine paying $270 a month and getting a premium notice that increased to $1,160 a month? And you say, Tony, what gives? What in the world happened here? Well, as you can see from this illustration, Aaron, let's take a tight shot of this illustration here. Look at the premium over there, how it goes from $3,507, that's the annualized premium of the monthly. If you take $270, that's $3,500 a year basically. I believe that's right, I think that's the right math. But look, it bumps up to $14,000 a year. And notice under the guaranteed values, in other words, if they raise the cost of insurance even more, it'll still lapse at age 80. But over on the non-guaranteed values, which means the insurance charges could go up, but so far they're just showing what they are now, this policy would run out of money at age 94. So it still falls apart at 94. So the person's dilemma is as follows. And they asked me this, Tony, we've already put in $83,000, right? Don't have anything to show for it other than if they would have died, obviously, the spouse would have gotten $250,000. We just got a premium notice of $1,160 a month. And here's what they asked me. Should we keep paying this policy? Now, they did do one thing. They went and contacted the company and asked them to lower the death benefit. Instead of $250 to $200, you can do that. And then the planned monthly premium dropped down to $907 a month. That's still a lot of money. So let's look at some options here. What could they possibly do with that? They could cash it in. They would lose all their $83,000, but they would get back cash value of $23,000. Plus, if he dies the next day, they're going to really feel like they did a bungle because they lose the $250. That's not really a good option. They could reduce the death benefit down even as low as $100,000. The problem with that is you still have a premium paid, plus a death, you're only going to get $100,000. Aaron, you seeing the dilemma here? I mean, this is one of these no-win situations in terms of working through this. So what I told him is, hey, before I make any decisions or give you some advice on your overall planning, we got to decide what to do with this because that death benefit is a huge component to their planning. These people have real estate, they've got tax issues, all kinds of stuff I'm trying to help them with. And I need to know, are we going to try to keep this death benefit of $250,000 in force or are we not? And they've got to make that decision. I am not going to decide that for them. Now, I can provide all the numbers, but it ultimately has to be their decision. Believe me, I don't want to be responsible for telling somebody to drop this thing and again, a year later he dies and you know, they're wanting the money from me. I don't have that kind of money laying around, folks. Now, what I want to do next is point to one thing here, and this will help understand this. Let's go over here and make some notes here. I know if you're listening to this on the radio, bear with me. The numbers are still the same. Yeah, you can always catch the TV show at TonyWalkerFinancial.com. YouTube channel has these. Certainly you can do that. But basically, let's look at this. And on this particular paper, I'm going to read to you what they've got. We have the total of payments for the year. That's $32.40. Here's the dilemma, okay? So over the next year, there's their premiums. There's fees, okay, of $90. So you got to subtract that out. The cost of insurance. See, the reason I'm not a big Universal Life fan is the cost of insurance continues to go up. They're going to have to take over $6,400 out of the contract to pay it. And they said, wait a minute, Tony, they only put $3,200 in. How can they afford to take out $64,000 where you're getting ready to see this? Now, it did make some interest. Okay, remember that 4.5%? It made $1,183 in interest, but here's the problem. The cash value, you remember originally it was $23,520 at the beginning of the year. They're projecting at the end of the year it's only going to be $21,404, and therein lies the problem. The cash value is now being sucked dry to pay this huge amount of cost of insurance, which is really only term insurance. It's just term insurance buried within the universal life. This is why I think term insurance is kind of a racket, folks. It's great if you need it while you're young and if that's all you can afford, but it is a disaster because if you live past the term, which is really what's happening here, the insurance company not only keeps all of your money, but they make all the interest on it. Plus, when you die, they don't have a death benefit to pay out. Heck of a good deal for the insurance company. So let me just show you my illustration real quick, and maybe next week we can cover it. How much time do we have, Aaron? We got to watch our time here. Yeah, we got to wrap this down. So What have I done here? Let's take a look at what I decided to do about 7 years ago. I took out an overfunded dividend participating life policy. I put in $29,614 a year. Now, I'm not going to pay this much forever. In fact, it would become a modified endowment if I'm not careful. But look at what I've already got after 7 years. The $500,000 life insurance, if I die today, has already grown to $924,000. That's a pretty good return, right? Tax-free, remember. Look at this. The cash value has already grown to $196,000. Now, folks, you say, what good's the cash value? Well, I'll tell you what good it is. I borrowed from the cash value to buy my oldest son's first home. I financed it, and now he's paying me interest, and I'm becoming the bank. A great deal. I love being this banking thing. So anyway, folks, dividend participating whole life is a great attribute for you, your kids, and your grandkids. Do me a favor. Log on to TonyWalkerFinancial.com. If you want a review of your estate planning, your life insurance, maybe somebody's recently talking about life insurance with you. Don't do a thing until you talk to us. We know these products very well, and we can make sure you're using them appropriately and strategically within your retirement planning process. Well, I'm Tony Walker. You're watching the Worry-Free Retirement. Does the Bible have anything to say about life insurance? Well, kinda, but you need to stay tuned to find out. But I got to get me a cup of coffee. You stay tuned. I'll be right back.
Call me old-fashioned, but I love the fact that my husband takes care of all the finances. But if something happened to him, where would I turn?
Whether you're divorced, widowed, or single all your life, don't go it alone. Attend my next free financial forum exclusively for single females. There's 2 times to choose from, and seating is very limited. Bring a guest and log on now to TonyWalkerFinancial.com, and I'll see you then.
For years, you've seen him on TV. Now see him in person. As retirement specialist and fiduciary, Tony Walker personally hosts his next free workshop, Retirement 101, Tuesday, August 15th in Bowling Green and Monday, August 21st in Louisville. Learn how to set up mailbox money and leave your worries behind. Attend Tony's workshop Tuesday, August 15th in Bowling Green and Monday, August 21st in Louisville. Mailbox money can help you enjoy and protect your retirement. Seating is limited, so register now at TonyWalkerFinancial.com.
Oh yeah, another good cup of coffee here. Welcome back to the Worry-Free Retirement, and we're talking about life insurance. And more importantly, we're talking about the idea of understanding what you've got on the front end, realizing there's basically no free lunches, folks. And usually over the long term, if something is steady as she goes, as we've talked about, in the long term, it's going to benefit you. And that's why, again, I shared with you briefly the dividend participating whole life policy I've got. It just gets better and better and better, but it takes a long-term perspective on that. And that's my concern for unsuspecting savers who are not looking long-term, or their advisors, unfortunately, always tend to explain all the good stuff and kind of forget the potential bad stuff. And that's what happened with our prospective client who, again, has a life insurance policy who in the 80s, in case you're just joining us, thought it was going to earn 10, 11, 12%. It's earned about 4.5%. It's falling apart. So where does the Bible come in on life insurance? It doesn't come in at all on life insurance, but it does give us a verse of Scripture that I think is very interesting, and it might help think through this idea of a long-term perspective. It's chapter 13 in Proverbs, and let's turn over there, Aaron, verse 11. Very simple verse of Scripture, as you can see here, depending on your version of the Bible, but basically it just simply says, wealth obtained by fraud dwindles, but the one who gathers by labor increases it. Now, given the fact that we've talked about maybe some unsuspecting savers feeling like, I wouldn't say it's fraudulent, but basically just very unethical, that a lot of advisors don't tell people the pros and the cons. The advisors, unfortunately, are always assuming the high interest rates rather than maybe assuming worst case scenario, which is what we try to do with most of our projections. Again, a gentleman came in the other day, as a matter of fact. It was interesting. He said, hey, my 401k's grown more than I thought. And we've got more over here, we got more over here. I just got this. And I said, isn't that great? In our planning, we assumed a lot lower assumptions. Now you're more excited about it. Wouldn't have been awful if we'd assumed real high projections and the stuff had gone the other way. You know, especially if you're approaching retirement. That's pretty scary stuff. So what we're saying is, for advisors out there, for people out there, be realistic in your assumptions. Realize that in general, wealth is accumulated over a long period of time. Slow and steady wins the race. You're not going to get anything by fraudulent activities or unethical activities, or if you do, guess what? In most cases, it dwindles. Why? Because you didn't get it the old-fashioned way. You didn't work for it. That's the problem with fraud or unethical activities. So again, if you're out there and you're going maybe some of these dinner seminars, or maybe you've talked to somebody recently and it just sounds too good to be true, you know what the old saying is? It probably is. So here's my point. With Scripture, we see that to fight against believing in things that may sound too good to be true, we have to take a long-term perspective. We have to think in terms of plodding along, doing what's right, looking at guarantees rather than always assuming we're going to make 8 to 10% on our money. Again, disciplined approach to money, slow and steady wins the race. Proverbs 13:11 is a great promise, but it also promises that we have to stay the course. We have to keep our hand to the plow. And that's why I like dividend participating whole life so much. That's why I like fixed indexed annuities so much. That's why I like conservative portfolios so much, because we don't make assumptions that may or may not be something we can keep. Well, how about you sitting there today? You might be thinking, Tony, this sounds just like what I ran into the other day. Too good to be true. Or maybe you're one of those folks that's got an old life insurance policy and you're worried sick that this thing is going to fall apart on you. Don't fret. Don't worry. Why don't we have an opportunity to meet? It's easy to do. There's no cost or obligation. Just go on to TonyWalkerFinancial.com. While there, you can click on the Meet with Tony button. You can contact me. Oh, by the way, wanted to remind you, be sure to order our brand new Mailbox Money for Life booklet. This is a great booklet, and it talks about the idea of our patented approach to money, mailbox money. Okay, this was something my granddad enjoyed, and you can too. To get your free booklet, Mailbox Money for Life, when you go to the Contact Tony section of the website, just say, mail me the Mailbox Money for Life booklet. Be sure to put your full name and full address, and we'll get that to you right away. Well, I hope you've enjoyed today's program. I've enjoyed bringing it to you. You've been watching the Worry-Free Retirement. And as always, again, don't let your worries creep in there. If all else fails, you try to be worry-free, and we'll see you next week. Have a good day.
Thank you for watching the Worry-Free Retirement with Tony Walker. If you need a safe and simple game plan for your retirement, log on to TonyWalkerFinancial.com and schedule a free, no-obligation meeting with Tony.